If you haven't already watched the preview, kind of the course overview, I would highly recommend you take the 15 or 20 minutes, whatever it is, and go through to look at the new IVY Learn system, to learn how the class is set up, what kind of things that I'm expecting out of the class, and then also how to get the tax tables and the ebook, because we will be using the tax tables during this lecture for this week 1. So let's jump right in. For this Accounting 205 class this week, we're not going to look at anything too complicated, but we are going to introduce a few things that like tax rates that I think are pretty important to know. And we're also going to look at how to fill out even the basic 1040 EZ to make sure just you have the basics down here for this first week. The second week is the week that I require for all online students to watch, because I think that may be one of the most important weeks that we have in this class. Knowing what filing status you're going to use and who can use it as a dependent, because there are so many different scenarios, especially with children with a divorce case, children who have never had parents that were married, spouses who live apart, spouses who have not seen each other for years but are still technically married. What do you do in all those weird situations? Well, let's start in here now with week 1. Week 1, the couple of the things that I thought were interesting is the United States tried to have taxation even back to Civil War days to help raise money for the Civil War, but it went through a Supreme Court case and they found that it was unconstitutional. There was not anything in there that says they could tax. So that was officially amended right before World War I, conveniently, to allow taxation on the United States. The IRS, I wanted to point out that a lot of people I seem to think that the IRS makes the tax laws, and that's not true. It's Congress who makes the tax laws. It's just the police who know the laws and then actually enforce it. Same with the IRS. Tax law, as you probably just know, it's very complex. If there's ever any doubt and you want to know exactly what the law states, you shouldn't look at the book. You shouldn't look at my notes. You should actually go to the Internal Revenue Code itself. That's where what Congress has put together and says this is the law of the land. Now, other items that are almost pretty much just as useful and relevant and that can be used in any type of court decisions are what are called revenue rulings, and we're going to look at those at the very end of the lesson today. And the IRS Treasury regulations, those are pretty much the IRS's interpretation of what Congress has set out. So they may not always be very clear in the code. Usually the revenue rulings try to make it a little more user friendly. Tax isn't just used to fund the government. That's the primary purpose, obviously, but it also is there to help support or discourage certain events. So they may tax you, for one example is the Obamacare. You get a tax or a fee, they call it. It's basically a tax that if you don't have health insurance, then you're going to pay. So they're encouraging you by having this tax to have health insurance. Looking at it from the opposite way, they encourage you to give and donate to charity by giving you a deduction if you are able to itemize. So those are just a couple of different ways that using tax rules, the government can help make things less or more attractive to individuals. Okay, the tax rate schedules, there's 3 different types of how taxes can be done. The most, I don't know if it's the most common, but the one that everybody I think is familiar with, and it's the way that the federal tax works, is the progressive rate, which means the more money you have that's taxable, the higher rate you're going to pay. So that's why low income people may only pay 5, 6, 7, up to 10%. of their earned income goes to taxes. Whereas somebody who makes maybe $1 million is going to pay upwards of 39%, 39.6% to be exact, of their money is going to be taxed at that high level. So that's quite a big difference. So that's called a progressive rate, where you're taxed at a higher percentage the more you make. The flat tax, people in Indiana are very familiar with this because that is essentially what the sales tax is. Everyone pays 7% when you go out and buy an item, no matter what you make. So that's why it's a flat tax. So somebody makes $10,000, they pay 7%, same as if somebody makes $1 million. Therefore, flat tax is usually a bigger burden on lower income people. A regressive rate structure. This happens when taxes are capped, and Social Security is a very common way to have taxes capped. Now, I don't know why these things don't get updated. I've updated this once, and it's not updated now. I must have not saved it. I don't know what I did. But this, for 2016, your cap is at $127,200 for Social Security. Any amounts that people make over $127,200, your rate, you don't get taxed at all. So I give this example to help illustrate what I mean by regressive. Anybody who makes under $127,200, they pay a flat 6.2%. That's your Social Security tax. So if you earn $55,000 at 6.2%, you haven't hit any cap, you're going to pay $34.10. Well, you work that backwards. $34.10 out of $55,000. There you go. It's 6.2%. Now, what if somebody made $170,000? The most they're going to be taxed at is at that $127,200. Once they hit the $127,200, they're done. So the most that they're ever going to pay, no matter how much higher they make, even above $170,000, is the $78.86. So if you take $78.86 and then divide that by their actual full earnings, for dollar, if they were to tax every dollar the same, they're only being taxed 4.63% of their income. So you can see the percentage, when you do it dollar for dollar on their whole amount, actually begins to go down. That's what's considered a regressive tax. And as you can probably imagine, the lower income people don't like it when there's a cap, because the rich, the wealthy, get more of a tax break, in a sense. All right, marginal and average tax rate. If you ever hear of anybody saying, well, I'm in the 10% tax bracket, or I'm in the highest tax bracket, which is 39.6%, you may think, I'm not really sure what that is. That's what I want to pull up here now. The marginal tax rate is, for every dollar, if you make one more dollar above where you're at now, say you make $10,000, and then your next paycheck gets you up to $10,600. That next $600, what is that going to be taxed at? Because what you were taxed at previously may have only been 5% or 0 or whatever it is. Now you're up into the next tax bracket, and then you keep moving up the more money you make. So at this point, if you have a book, let's pause the lecture if you need to and open up to Appendix F. It's in the very back. If not, you'll want to go into the book website, as I talked about in the first video. Go into the additional student resources. When you go there, this is what will come up. And then click on the bottom one here, the tax rate schedule. And I will also bring that up. This is what it will look like when you click on that bottom item. The first thing you have to do is find your filing status. Now again, we're going to talk about that next week, so I'll have to give that to you on all of our problems today. But let's say you're somebody that's single, and let's say you made your taxable income is $20,000. If you're $20,000, you're in this row here, and you'll know your marginal rate by this percentage sign right here. So that means if you're at $20,000, if you made one more dollar you made $20,000 in $1, that next dollar would be taxed at 15%. So 15% of that dollar would go elsewhere and not in your pocket. Whereas if you made $200,000, you're in the 33% bracket. So that next dollar over $200,000 is taxed at 33%. Now, I wanted to point out that that doesn't mean every dollar that you earned when you make $200,000 is taxed at 33, because those first few dollars that you made at the beginning of the year, in a sense, they're taxed very low at nothing. Now, when you have taxes taken out of your paycheck, they combine it into a nice neat, so it's not a very little at first and then more and more later and later. They average it out. But what that means is your first dollar, all of your money isn't necessarily taxed at 33%. It's taxed as you go up. And then that next dollar that you make, if you made another dollar, it's 33% all the way up till $413,000. Above that, you're going to go to the next, and then finally at the top bracket here of 39.6%. And you can see when you get down here to married filing joint, the numbers are, at least for the beginning, they're pretty much double. But then once you get further up, they're less and less, and the top bracket is only just a few, not very far different from the single person. So that would be considered a marriage tax penalty, where if you had two people and they both made, say, $230,000 and they were single, they're only going to be taxed at 33% each. But put them together as married and they both made $250,000, they're going to make $500,000, and so now they're going to be taxed at a 39.6% rate, at a higher rate just for being married. So that would be considered a marriage penalty. Let's go back to my notes now and kind of begin to put some numbers with this. But one thing I did want to note here is the numbers that you see on this chart, the key word here is taxable income. Taxable income. So that's not your gross income. Taxable income is after you've taken all of your deductions, and you've taken your standard deductions and maybe any credits that came your way. Not credits. Your adjustments to gross income, and then things like your standard deduction or your itemized deduction. After you've taken those deductions, that's what your taxable income will be. And so I wanted to make sure that was clear. It's not just your gross income. There is a problem or two in the book that will try to trip you up. One of them will say your taxable income is $50,000. The next problem will say your gross income is $50,000. Determine the taxes. Well, then you're going to have to know, and we'll get to this in a little bit, how much do I need to deduct for the standard deduction before to get to our taxable income. Because as you'll see here in my next little item here, taxable income is your income less your standard deduction and your personal or exemptions. Now we're only going to look at cases where we have a single person or a married couple with no kids, but as we go further on, they won't be as simple. Now the big difference between marginal and average. Marginal rate is where are you at the next dollar you make. Average rate is what are you on average paying. If you make $200,000, you're not paying 33% on every single dollar. You're only paying 33% on everything over that you made over $190,000, $150,000. All those other ones you paid a little bit less, all the other dollars that you made. So we need to decide, well, what is our average income tax bracket? Average should always be lower, except it will be the same if you're in that very beginning tax bracket at 10%. So let's do an example. I want to know, here would be the main question, and then the answers here, I already have them out, and that's just to help us go through it, and then we're going to work on a couple on our own. Bill's income is $99,000, and I put that this is his taxable income. So he actually made more than that gross, but taxable income is $99,000, and I want us to determine A, what's his marginal rate, and B, what is his average rate? All right, to determine his marginal rate, we need to go look up somebody who is single and where do they fall in if they make 99,000. So here's our marginal, where we can find marginal information. Somebody who's single, and if they make 99,000, they're in this row. So every dollar above 99,000 up to 190, they're going to pay 28% tax. So they are considered in the 28 tax bracket, 28% tax bracket. Now, to get their average rate, we actually need to know how much money do they have to pay. To get the average rate, there's two methods. The long method, which I'm going to show you first, and then the much quicker method for those who make under $100,000. If you make over $100,000, then you have to always do the long method. But we'll start out here with the long method. What you have to do is it's kind of like payroll. It's similar to payroll. If you have taken payroll, we work this row backwards. Okay, so 99,000 if somebody's single and we want to know how much tax do they owe. We start back here, 99,000, and then we subtract how much it's in excess over. So we subtract out 91,150. And that's the first thing I did here. And you're going to get something 7,850, I believe. And then you're going to go to the next step. You're going to multiply by 28%. So that 7,000 and some times 28%. When you do that, you should get 2198. Then the last step, after you've done that multiplication of 28%, you're going to add in this final number, 18,558. Once you add that in, that tells us how much tax, what their tax liability is. So this person overall owed 20,756. Now, I'm sure that they paid in, so they wouldn't have owed all of that at one time, but that was their total liability. Now, to get the average rate, you need to take that 20,756 and divide it by their actual income. So now remember, their marginal rate was 28%, but their average rate, what they really paid overall, was only just under 21%. Because remember, all of the money they earned below, they paid at a lower tax rate. So on average, they only paid 20.97%. Now, there is an easier way, and this is in the back of your book as well. It's a lot more pages. The Appendix D, it gives you a whole listing, so you don't have to do this long method. It gives you a quick reference to see what is the tax due. You can find this also if you click on that opening page that you got from there's different ways of getting this. This is from the book site. You can also click on the website here for the irs.gov site, and this is the 1040 explanations for the 1040EZ. Go to page 33, or it's also in the back of your book. So if I click on the tax tables, this is probably the easiest one for me to bring up quickly. All you're going to do is you're going to determine what your taxable income is. Make sure that's what you're given, and that's what I was given in this problem. I wasn't given gross income. And then I'm going to go all the way to the bottom because I'm at 99,000. So I'm at least. Make sure you pay attention to this at least but less than. So if my income was $99,050, I wouldn't use this top line because it says less than 50 to 99,050. I would actually use this second line. So I have at least 99,000 and I am single. So my answer would be this 20,764. Notice how close that is to the one we just calculated. 20,764, and the one we calculated was 20,756. So within $7 or so. of the same amount. And the only reason there's a difference is because the charts that we just looked at, notice they go in $50 increments. So it's not going to be exact. They're basing these numbers off the middle, $99,025. All right, let's skip down now to how the 1040 is laid out, kind of where we're going the rest of this semester. So with that, I'm going to pull up a 1040. Let me go ahead and just take 10 seconds and pull up a 1040. I don't know if I have one in my notes. So how the 1040 is laid out, we're going to look at a 1040EZ here in just a few minutes. But the 1040, I kind of wanted to give you an overview of where we're going for this semester. Next week, we're going to look at these two in detail. Who can we claim as an exemption, and what filing status should we use? So that's week 2. We're going to do week 3. We're going to look at the tax return. We're going to look at the tax software, everything there is to know about that. Come week 4, we're going to look at a lot of these items, a lot of income items. Some of them we're going to split out and do a week just on their own, but that's the second half. For example, week 12, business income, we have 2 weeks just for that. We have a week just for capital gains. We have a week just for pensions and IRAs. So some of these we have their own weeks. Week 5, we're going to look at this bottom section, the adjusted gross income. With this section, there's not a whole lot here, so we're going to have time to also look at the Obamacare, which is known as the Affordable Care Act. And we're also going to look at the flat tax option in this week. In week 5, we're going to look at the difference between a standard deduction and itemized deduction, and what actually this would be week, this is week 4, this is week 5, this is week 6. We're going to look at the difference between the itemized deduction and standard deduction. We're kind of looking at this stuff now, the taxable income and what's your tax liability, looking that up in the back of the back of the book or whatever form we want to use. In week 7, we're going to look at these credits here. These credits, and then also a few credits down here. Most of this here is beyond the scope of this class. We're not going to get to most of these other taxes. So that kind of gives you an idea, kind of the layout of where we're going the next few weeks. Go back to my notes. So how it's laid out, the gross income, chapter 3, we're going to look at that in week 4. We're going to look at the deductions in week 5 in chapter 4. This is just for your information. All right, let's look at the 1040EZ. This one is, a lot of people can't use it. If you have kids, you're automatically out. If you're 65 or older, can't use it. If you're lucky enough to have income over 100,000, you can't use it. So there's a lot of things you can't use. These are the basic forms that everybody will fill out every year. 1040EZ. Most people can use the 1040A then. There's not very many that actually have to use the full-blown 1040. I'm just talking people with just a single job, nothing weird, no personal business. They can use the 1040A. There's a few exceptions where you need to use the full 1040. But let's go through some of the requirements. Notice you have to file single or married filing joint. That is it. You cannot file as head of household and still use the 1040EZ, mainly because you can't have any dependents when you do the 1040EZ. That's number 3 here, no dependents. Anybody older than 65, you get a little bit more of a standard deduction. So that's why you can't do that on the 1040EZ. You can't be older, 65 or older. They got the income limits, because generally if you make over 100,000, you may have other things that need to be monitored a little closely, more closely than the 1040EZ does. Almost all of the credits are not allowed, the only exception being the earned income credit. And the earned income credit is very limited in this case as well, because if you don't have kids, because you can't have any dependents, so therefore the income credit, the earned income credit would be limited to only those with very, very low incomes and still meet the age requirements and the income requirements. And we'll talk a lot more about that when we get to that point in the semester. All right, at this point, let's go ahead and pull up the 1040EZ. That'll make more sense. These are all instructions. I'm gonna now go back and pull up the 1040EZ. This is one of the items you don't necessarily have to fill it out and send it in. What you're gonna do is fill in the amounts, and then in your quiz, it'll say, what is box 1? What is box 4? What is box whatever? And then you're gonna fill in those amounts. So as we're going through with the 2016, notice there's nothing you need to put in here for your filing status or dependents, because it's either single or married. So if you fill in 2 people, it's automatically going to be married. One key thing that I will look for as we get into doing tax returns is you definitely need to check and double check your social security numbers and the spelling of the names to make sure those are spot on. Anytime there's a difference, you will get a rejection, and then that's just time consuming and just looks bad, makes it look like you're not very attention to detail. So we're gonna start and make sure we have all of our wages and salaries here in box 1. Make sure you ignore the items that are not relevant, and I'll talk about that as we look at the example. Taxable interest, you should get a special form if you do have taxable interest. It'll be called a 1099 INT, and as long as it's under $1,500, you're fine. Unemployment is still taxable. For tax laws, the only item that's not taxable is what's called workman's comp. Just don't get those two confused. Unemployment means you're not working. Workman's comp means you got hurt on the job, and you may not be working at the time, but you're still employed. Add up all those, we get our adjusted gross income. Then what they have done here is they made the standard deduction and personal exemptions very easy and straightforward. If you're single, then you get the standard deduction for somebody who's single, and then your one exemption. And when you add those two together, it comes out to be $10,350. We'll see that more next week as we look at the standard deduction in a little more detail. Double that if you're married filing joint. The standard deduction happens to be double the single, and then you also get another personal exemption, one for you and one for the spouse. So you're going to enter $20,700 as a deduction from your income. So remember back a few minutes ago when I said, make sure you know the taxable income, not just the gross income. The gross income is here, what you'll find on line 4. Your taxable income is after you subtract the deductions that are given to you, which is in this case the standard and the personal exemption. Box 7, you then enter in what the W-2s add up to be. Box 2. Box 2 is your withholdings for federal withholdings. And we're going to compare at that time, compare line 7 and line 6. How much did you owe, and how much did you have submitted already that you've paid in? We're not going to look at earned income credit at this point. We're going to get to that much later in the semester. We're not going to look at Part B either, 8B. So line 7 and line 9 will be the same. Line 7, then we're going to use, or line 9, to look in the back of the book to see how much tax do we owe based on that dollar amount. Maybe we have, and this is where we're going to, I think I said compare line 6 and 7. That's not true. We're going to compare line 7 and 10. Line 7 is how much money did you put aside for taxes, and line 10 is actually how much do you owe. And then we compare those to get line 12 to see if you need to pay more money. Line 13 here, line 14, if you need to pay more money, or if you get a refund. This last line, line 12 or line 11, we're going to talk more about that in week 5 when we talk about the Obamacare. So for right now, we're going to assume people did have full coverage and there's no additional tax there. So let's go through the example that I have and how we would fill out this 1040 EZ. So I've got a married couple, total W-2 income of $37,000. Box 2 of the W-2, so that's the federal income withheld, was $4,000. Unemployment $3,500. Paid $6,000 in child support. Paid $8,000 in rent. All right, let's go through and start using some of these figures in our 1040 EZ. Now this isn't a fill-in version, so what we would have for line 1 there would be our total W-2 income, $37,000. I didn't say anything in the problem about any taxable interest, so that would have just left blank. I did tell us that we had unemployment of $3,500. So these two we've now used. If we put in $3,500 here, so our total adjusted gross income would be these two added up, $40,500. Just kind of a recap. Line 5, this is a married filing joint couple, so they get to subtract the $20,700 as their standard deduction and personal exemptions. Line 6 then tells us what we would look up in the back of the book. We're going to look up the $19,800. But before we look it up, let's go ahead and fill in line 7. Line 7 says how much was withheld from your payments. That would be this number here, the $4,000. So we would enter in $4,000 as being paid through our payroll reductions. We're not going to do line 8 or 9 at this point. So line 9 would then also be $4,000. Line 10, we're going to go back up and look at our taxable income. Our taxable income was, right here, $19,800. If you go in and look up 19,800, not here, this other one, this one, let's go to 19,800. For somebody married filing joint, that would be right here. And this would be, let's make sure we're in the right column. Married filing joint is our second column. 19,800 says we owed $2,046. So $2,046 is what we would put in as our tax liability. And then we simply take the difference. And knowing that our liability is less than what we paid in, this is the amount we're going to get back, $1,954. All right, let's, that's kind of in essence what the hardest part of this whole chapter. The rest of this I can go through in less than probably about 5 minutes. How long to keep records? Key thing here to note is typically you want to keep things 3 years because that's the statute of limitations. Most companies will end up keeping things 7 years. There's a few other little limitation rules in there, but for the most part 3 years should be fine. A term that you want to be familiar with, something called an Itn number. This is for those who for those taxpayers who don't have a Social Security number, so therefore they're not a citizen, most likely, they'll have an Itn because they still have to file a tax return. They still made money in the United States. It's just they maybe are here on a green card, some kind of a visa, so they get what's called an Itn number. It's just a number to use instead of a Social Security number because they don't have one. Who must file a tax return? That is one of the first things that I have on the spiral document that I will have available for you. I'll have it updated. I'll just open that up real quick. Who must file a tax return? I believe I have this on the very first page. Yes, I do. This goes through and tells you if your gross income and you're single under 65, your gross income was $10,350, you need to file. Married filing joint, both are under 65, you need to file if your income together is $20,700. Notice that's gross income, not taxable income. There are some other things down here that you may be interested in. And then, well, what if you're a kid or you are claimed as a dependent on your parents' tax returns? Here are some rules for those individuals if they have to file. If you're a single person and say you're 25, 23 years old, still in college, you would have to follow these rules. Your unearned income was over $2,600. That means like interest, dividends. If your earned income was over $7,850, then you would have to file. So different things here. And then here are some other more odd situations, but when you still have to file, you might want to look through these. Just some interesting little things. And then who should file. Automatic extension. A lot of people who have their own business, or especially in a partnership or a corporation, if they are a major owner of that, they're going to do an automatic extension just because it takes so long to do their normal business tax return. The taxpayers don't have time, preparers don't have time to also get their individual done. So you can do an automatic extension up through October 15th. So you just file in this paperwork, give an estimate of how much income you think you're going to have, an estimate of what you're going to owe, and then what you've already paid in. And then if you have a big difference there, you pay that at the time before April 15th. This is an extension to file, not to pay. So if you end up owing when it comes to be October 15th and you're ready to file and you owe $500, you're going to have a penalty on there and interest because you didn't pay it by April 15th. So you should always be conservative and pay if you think there's any chance you might. The last things that I wanted to go through for this chapter was the tax authority. What kind of items, if you ever get in and you need to know who should I rely on, what kind of things can I trust, this would be the order, the things that you want to go to get some information. So the statutory sources here, the Internal Revenue Code, the other things are, I need to clean this up and make it a little bit better, but there's some things called the revenue rulings, and I'll go through and I'll try to clean this up sometime soon. But there are other items that are authority, all the way down to like your tax textbook. That's not really something that you could rely on if you ever had to go to court. You'd want to go back up and use the actual IRS code or the Treasury regulations. Any type of tax rulings would also work. Oh, here they are. I do have them. I'll probably need to delete the stuff further up. The tax authority here, the Treasury regs and the revenue regulations, these you can look up. You can find them. You can especially find them if you ever need to do an actual deep research. Most colleges have a subscription to this. Most tax companies would have subscription to this. This is a huge database of all tax law, tax codes, everything you could know. The additional tax authority, tax court cases generally can be relied upon as long as they're within your district. Even if they're not, most of the time they can still be relied upon. The Appendix B talks about it's scary that with today anybody can put out a sign in their front yard and consider themselves a tax preparer. So you want to be very careful if you're ever picking a tax preparer. Are they a CPA? And if they're not, they don't have to be. Are they an enrolled agent? Even if they're not that, how much experience do they have? Background, education? Do they have at least a background, a degree in accounting? Right now, this paragraph is being in the court process. The IRS was sued and they actually lost the lawsuit. They're not allowed to charge a $65 P10. A P10 is a prepared tax number. And what that did is allowed the IRS to make sure that preparers were following the rules, make sure that preparers did have some background in taxes, but right now that's up in the air whether that will continue. If you ever want to work in a professional and do taxes, you'll want to be one of these three, because then you can prepare and go in front of the IRS and to a court and represent a client if you're a CPA or an enrolled agent. And then these registered tax preparers, these are people who have actually gone through and did some continuing education, and they have proven that, and that's when they get that P10 number. Paid preparers, they have to sign all returns. You're actually liable if there's some things you don't do. If you prepare a return that you know is probably false, you're going to be liable. You're not liable if you prepare with good due diligence. It means you took all the information that the taxpayer gave you and it all looked in order, but maybe they didn't give you one big W-2 and you just didn't know about it. That's not your fault. The preparer would not be in trouble at that point. The preparer would be in trouble though if their client came in with only $20,000 in income showing, but came in a nice brand new Corvette. Some things should ring a bell there that there's some red flags. So that's what this realistic possibility is. That's part of it. The other thing is if the taxpayer says, hey, I want to take a deduction for paying the electricity for my dog to have a winter blanket outside, and they claim that there's some rule that allows them to have it, you better be real sure. Otherwise, you don't want to claim it unless there's at least a possibility that that could be true. That could be allowed, I should say, in the tax law. It's very probably true that they do have the dog blanket, but it's not really allowed to be a tax deduction. You don't want to ever get your client's information and then give that out to other people. That is a big no-no without their express written consent. And the other thing you can't do is say, I'm going to charge you based on how much of a refund you have. So if I get you a refund of $1,500, I'm going to charge you 10%. If I get you a refund of $2,000, I'm going to charge you 20%. Can't do that. You have to set a set fee no matter what. Okay, with that, you'll need to go in now and go into the tax book at the end of the chapter, and then you'll also want to go into the IVY Learn and look at the additional final question that deals with the 1040EZ. Write all your answers out, and I would submit them to me for review. Remember, if you do that by Monday morning, I will give you the credit. I will give you feedback on what is incorrect, and then you can submit that by Tuesday night. Remember, the deadline is Tuesday night by 11:59. Your first welcome document and your first discussion board replies are due by this Saturday, this first Saturday of the semester. Tuesday is your deadline for the rest, the replies, and your homework. With that, we will call it a week. Next week is our only required lecture, and that will be over week 2, the dependents and filing status.